Hey, how are you today? This is Josh Patrick, and you're at Cracking the Cash Flow Code. And my guest today is Eric Hoelter from Asset Mark Retirement Services. And I've been trying to get Eric on the show, I don't know, for quite a while. It took him a while to get permission from Asset Mark to do it, and it took me a while to realize he had gotten permission from Asset Mark to do it. So I wanted to do this almost a year ago, but here we are today. And the reason we're going to bring Eric on is one of the things that we find out is that most private business owners, when they look at the value of their business, is not going to get them to retirement by itself. But you probably are making more than enough money to pre-fund your retirement. And we're going to talk about that during the show today, but let's bring Eric on and we'll start the conversation. Hey, Eric, how are you today?
Hey, Josh, thanks for having me. Pleasure to be here.
My pleasure. So let's start talking about retirement plans. And I want to get sort of into the advanced stuff pretty quickly. Most people, when I say, gee, I ask a business owner, you have a retirement plan? And they say, yeah, I have a SEP or, simplified and, uh, retirement plan, or I've got an IRA, or maybe they even have a 401k plan, but that's about as far as it stops. Problem is, most business owners never really start thinking about retirement till they're about 50. And those plans, although they're nice, will not get you enough money to get to retirement. Is that something you find often when you're looking at plans or looking at businesses that want plans?
Yeah, absolutely. A lot of business owners tend to think of their net worth in terms of the value of their business or the value of their home, without really taking into account like some advanced planning capabilities that are there. There's a lot of tax management that can be done. There's a lot of investing that can be done, and really, leveraging compound growth to reach those lofty goals. So, it's not kind of and my grandfather, when he retired back in the 90s, he always said, hey, I've got this number. It's $1 million. That's my goal. As soon as I hit $1 million, I know I'm good. But if you do the math in today's world, and everything has gone up in price, $1 million really isn't even enough at this point to secure a financial retirement. So, that's something that I see a lot of financial advisors talking with their business owner clients about, and something that AssetMark is able to support on the backside to help those business owners save for retirement and reach their goals.
Oh, here's something I find is that, when I first started in this industry, they would say, ask for 15 minutes for a business owner and tell them they need to diversify their investments because they have all their eggs in one basket. And in my experience, anytime I've ever said that to a business owner, including myself, I kind of poo poo it because, frankly, I'm okay with having all my eggs in one basket. But when I go through, we have a tool called the Four Boxes of Financial Independence. And we have an ebook on that, which you can get by downloading it below. But at any rate, what the ebook's going to teach you is that, let's say you have a business that makes $200,000 a year. And if I can sell it for a multiple of five, that means I sell it for $1 million. And after paying taxes and fees, I'm probably left with 600,000. That gives me approximately $24,000 a year to spend. And if my business is making 200,000, I can guarantee I'm not living on $24,000 a year. So I need to do something else. And that something else often is a qualified retirement plan, which you're an expert in. So let's talk about, we go above the 401k plan, which everybody pretty much knows about. Let's move to what's called a profit sharing plan. And let's also understand that every time I talk to a business owner, they're interested in putting money into their pocket, the vast majority. So with a profit sharing plan, how would they go about doing that? And how much could they put away?
Yeah, so that's a great question. And with any 401k plan that I'm working on, we're going to include a profit sharing bucket or component inside of that plan. And so it's often a discretionary profit sharing, which means that, year to year, if you have a good year, you can contribute to it. If you maybe have a more lean year, you can choose not to. It's at your discretion, really. So the discretionary profit sharing on a base level, you can do a pro rata. So you might say, come up with a budget. Hey, we've got $100,000 of excess profit this year that we want to invest into the profit sharing plan, and we're going to do it pro rata, and that goes across all of your employees in equal percentages. There are advanced methods of calculations that can be done on a profit sharing plan. They're referred to often as new comparability, or sometimes referred to as a cross tested plan. And what that essentially does is you can group together in a legal way that's not discriminatory, group together a preferred group and a non preferred group. Or you could have multiple tiers, or you could even make each employee their own group. And through actuarial calculations, we can steer a majority of profit to the preferred group and minimize the non-preferred group. Most often I see this applied as the business owner. So the business owner, or owners would be in the preferred group, and the employees would be in the non-preferred group. And, often we can steer 80, 85, sometimes 90% of that profit towards the owners group, and then give a minimal contribution to the non-highly compensated employees. So for 2023, you can actually do in a 401k profit sharing a combined 66,000. That's 22,500 of your own deferral out of your own paycheck, and then the remaining 43,500 could be a combination of a match that's maybe given in the 401k along with the profit sharing contribution. And then if you're over age 50, you get a $7,500 catch up. So the potential is there to do up to 73,500 this year in a 401k profit sharing plan that would be tax deferred for future growth.
So let's say you put that $100,000 away, and now you're taking 73,000, putting it in your pocket, which is 73%, and the other 27% would go to your employees, or $27,000, and that can be through a match and a profit sharing contribution, correct?
Yeah, that's correct. So your 66,000 or 73,500 with catch up would be your combined limits of your employee deferral. So the money you're choosing, or the percentage you're choosing to defer out of your paycheck, combined along with the employer contribution, which could be a combination of match and or profit sharing. So those are the caps that are set, by the IRS for 2023.
And typically, most business owners who go down this road probably have a 401k plan already, and they're probably giving their employees about $20,000 already. So it's for them to get to that big number, it's only going to cost them a few $1,000s extra. Is that correct?
Yeah, the goal with the new comparability profit sharing is to try to minimize the amount that's going to the non-preferred group and maximize the amount that's going to the preferred group. So in our example, yeah, if you had $100,000 profit sharing, budget, you could essentially count on, maybe 10, 15, 20,000 going to the non-preferred group, and all the rest of it getting steered to the preferred group.
That's incredible. So let's talk about what I call the retirement plan on steroids. And this would be for someone who is a little bit over 50 years old, somewhere between 50 and 60 years old, has undersaved for retirement. Their business is making a lot of money, and they don't need to reinvest all that money into their business. In fact, they probably shouldn't reinvest all that money into their business, because they're not going to get it back when it gets time to sell it. So then we move into what at least I call a hybrid plan. I think that's what the plan is called. And this is where we combine everything we did before with a cash balance plan. So Eric, can you please explain to us what a cash balance plan is, first of all, and then we'll talk about what I call the unlimited plan?
Mm-hmm. Yeah, so the cash balance plan is really it's a defined benefit plan. So think along the lines of a traditional pension, but it's got some characteristics that make it look and feel more like a defined contribution plan, such as a 401k. So rather than a promise to pay a future income stream like a traditional pension, a cash balance plan is a promise to pay a future lump sum. And so, as it's a defined benefit plan, the maximums are much, much higher than a defined contribution plan. Most often, we see the two plans used together, as a what is considered a combo plan or a stackable plan. So you'd have the 401k profit sharing on one side where you can do your 73,500, and then you stack a cash balance plan on top of it. And combined, in some cases, you can get, depending on how the demographics work out with your employees and your ages and incomes and all of that. But I've seen business owners be able to get, $200,000 or $300,000 a year in deferral capabilities. And the only kind of caveat is that with the cash balance plan, your contribution amount is going to be coded into the plan document. And so you are committed to 3 years. You have to fund at least 3 years of this cash balance plan in order to not run afoul of, the IRS and DOL guidelines. But it's tremendously powerful, especially in combination with a 401k profit sharing plan, to be able to get very high levels of deferral capabilities for your business owners. In terms of the cash balance plan calculations, again, they're done with an actuary. So it's a very similar formula as with the new comparability profit sharing. It's just on a much larger scale. So we do the same thing. We get a census information, all of your employees' date of birth, their date of hire, their income. We group together a preferred group and a non-preferred group, and then the actuaries work their magic to steer as much of that cash balance contribution to the preferred group. But they also, you're required to give a minimal contribution to really anybody who qualifies for the plan. So you might have to give a couple $1,000s to each of your employees, but simultaneously possibly being able to put away hundreds of thousands of dollars for you as the business owner.
So let's go back to the 3 years that you must fund the plan. My understanding is that you can overfund the plan in the first year or two. So if your out years are bad, you have extra money already in the plan, and you might not have to fund it as much. Is that still true?
That is true. So essentially, you don't, it's looked at each year, but you might have to. Well, really, this is more tied to kind of like the market performance of the underlying investment account. So there's going to be an assumed rate of return in the plan document. Usually, that's around 4%. So if you go in heavy into equity investments, which are higher risk, higher return, you're potentially going to have a really great investment return, which in a traditional investing account, that'd be great. But really, what you're doing in that scenario in a cash balance plan is you're limiting your ability to defer in the future years. So you want to have relatively conservative, low volatility investments and targeting as close to a 4% rate of return as possible. Because if your investment account surges 15 or 20% in 1 year, that's going to limit your deferral capability in the following years. And conversely, if the markets take a dive and your investment account drops 10% for this cash balance plan, then you might have to overfund the following years to get it back on track and get it to where it needs to be. So it's a delicate balance, and we work with financial advisors and business owners to walk that line and make sure that they're getting all the deferral capabilities that they need.
So the question I would ask those who are listening to ask themselves, let's say you have figured out that you are seriously underfunded for your retirement, and your business is doing pretty well today and is making a fair amount of money, more than you need to live on, more than you need to grow your business, and you've been trying to figure out what to do with it. This is something that's completely safe, completely safe as far as the law goes. There's a lot of strategies out there that financial advisors may walk into your office and say, I've got this great thing for you. You can put away $150,000 a year and you're going to get this wonderful result in the future. The problem with a lot of those sort of plans is there's really no black letter law that the government and the IRS can follow. This is black letter law. There is no risk from being audited and being found at fault with doing a tax shelter. The other thing I want you to be thinking about, which I think is really, really important, is that the question you want to be asking yourself isn't, should I have a retirement plan, but how much, if there were no rules, could I put into my plan? Now, I've been doing these plans for a long time, and Eric is the guy we've been doing it with for the last 5 to 6 years. And the reason I ask that is because I've never had somebody even get close to the maximum amount they can put in. The most we've ever had was $200,000, and I could have put over $300,000 in, but they couldn't afford it anymore. So there's a question I want you to be asking yourself: if there are no rules, how much money would you be putting into your retirement plan? So, Eric, let's talk about pitfalls for a little bit. What are the things that get in the way of people doing retirement plans?
Well, certainly, when you're a business owner, you're very immersed in your business. You're thinking about your business day in and day out, and we can almost have a tendency to kind of get blinders on, and to not really think about the future. But we're really just working so hard and diligently to try to build this business. But really, as they say, diversification is the only free lunch in investing, right? So um, you know, thinking about your future, having a multi-legged stool to support you in retirement is really a better way to think about things and to think forward. So I would say, pitfalls, getting those blinders on and not thinking about the future, not remembering the I guess the incredible power of compound growth, because as you and I know, you see investing is like a crock pot. So money just goes in, it goes in, it goes in, and hopefully it's out of sight, out of mind, and it just simmers over time. And then before you know it, you've got this wonderful meal. You've got this large nest egg that you're able to live off of. So I would say that that's a big pitfall. Other pitfalls that I see, unfortunately, I do come across a number of business owners that are resistant to kind of investing in their staff. So they're not wanting to do a match. They're not wanting to pay the cost. They're not wanting to have this benefit that's going to be an additional cost to them. But in my mind, that's kind of a short-sighted way to think about it, because you want to make yourself really an attractive employer. If you want to attract and retain top talent, anybody who's worth their salt is going to be considering whether or not you have a retirement plan. And if so, are you investing in my future? Are you willing to do a match? Is there a profit sharing component? Is there something more that you want to invest in me as an employee? Not only that, but through vesting schedules that we can employ inside of the plan, you can make this a great retention tool. So if somebody has a profit sharing contribution sitting in their account and it's on a 6-year graded vesting schedule, they know that if they leave within 6 years of being hired there, they're going to forfeit a portion of that profit sharing contribution. So there's different tools and levers that we can pull. And if those people do ultimately elect to leave early, guess what? That unvested amount goes into a forfeiture account that you as the business owner can utilize to pay expenses, or you can utilize to fund employer contributions or matches. So there's not a whole lot of reasons not to do a plan. Another pitfall I hear about is the cost of the plan. Starting up a plan can be expensive. You're looking at a couple $1,000s for a 401k profit sharing plan. What a lot of people don't realize is that through the Secure Act and now the Secure Act 2.0, there's credits that are available that have been expanded, and you can get pretty much all of those costs credited back to you, capped at $5,000. So there's really no reason not to do it, and it's just something where you have to make that determination whether or not you want to invest in your staff and your employees, or if that's not something that's of interest to you.
So is that $5,000 just once, or is that $5,000 annually?
It's 5,000 spread over 3 years of tax credits that are available. The Secure Act of 2.0 really expanded. It used to be 50% of the fees could be covered. Now it's 100%. So there's a lot of nuances and layers to it. We always advise business owners to talk to their tax advisor on exactly how much of that tax credit they qualify for. But the reality is a lot of those costs of starting up a plan can be offset under the current tax credits.
So we only have a little bit of time left, Eric, and there's an awful lot of businesses in this country. It's actually 30 million businesses, and about 24 million of them have no employees. And those are the people who really need to do a retirement plan, because their business just, there's nothing for them to sell. They're the business. So there's a bunch of solo plans and not IRAs or simplified retirement plans. What can they do to save in a big way for themselves?
So we see this probably as one of the most common types of retirement plans, the solo K or individual K. And it is a 401k plan. It's subject to the same maximum and limits of a group 401k plan. So you got your 22,500 deferral, your $7,500 catch up. You can do profit sharing, employer contributions, and max the whole thing out at 73,500 for 2023. Um, a solo K is more simple than a group 401k plan because you don't have employees. There's no testing, there's no non-discrimination testing that goes into it. Therefore, there's less effort and resource needed on the record keeping and administration side. Therefore, less cost to run a solo K. So you kind of get all the benefits of a 401k plan. You can even take loans against a solo K. You can take hardship withdrawals, and you can do Roth contributions as well, but you're doing it at a much lower cost than putting together a group plan. I do often see solo Ks again paired with a cash balance plan for business owners that are blessed with the problem of too much cash flow and nowhere to put it. So, we do these combo plans, solo K, cash balance plan, and again, we can get that business owner sometimes hundreds of thousands of dollars in tax deferral capability. And, this most commonly comes to us by way of the tax advisor. So the tax advisor comes to the business owner, end of the year. Holy cow, you did great. You had so much profit. We need tax write-offs. We need a way to shelter this. Talk to your financial advisor, get set up with an individual K plan or a cash balance plan or both. So that's something that the financial advisor helps with. And often they come to me. We help them put together the plan, design it, get the plan document, choose the investments, and fund the whole thing. So the great thing about a solo K plan as well is that you have until December 31st to do your employee deferral, the 22,500 and the catch up, but you have until your tax filing deadline, inclusive of extensions, to actually do the employer match or profit sharing contribution. So there's some flexibility in the timing of how that can be funded as well.
That's great. Hey, Eric, unfortunately, we are out of time. And your information is really good, and you are obviously an expert at this sort of stuff. If somebody wanted to contact you and find out more about retirement plans, how would they go and do about it? And if you're a financial advisor, more importantly, because you work with financial advisors, how would they get in touch with you for you to help them to put plans together for their clients?
Yeah, thank you so much for having me. This has been a pleasure and a great conversation. In terms of a business owner reaching out for help, really in my role, I only work directly with financial advisors. I'm kind of in a support role on the back end. So you would talk to your financial advisor and say, hey, we have saw this podcast or heard this podcast. I have interest in these concepts. Can you get in contact with AssetMark? AssetMark is the name of the company. If you are a financial advisor and you have questions or interest in learning more, feel free to reach out to me directly. My phone number is 925-375-0121. I cover the Northeast portion of the country, but I have colleagues across the country as well. Or you can also email me at Eric, ERIC, Hoelter, HOELTER, at assetmark.com, ASSETMARK.com. So we would love to have that conversation and help you and your clients to save towards those retirement goals. It's very important. There's definitely a retirement crisis in our country, and we want to do everything we can to help folks save for their future.
Great. Hey, Eric, thanks so much. And I've got two things I'd like you to do. The first, I've asked you to do 395 times. And that's to go wherever you're listening to this podcast and give us an honest rating review. If you love us, say so. If you hate us, say so. And I'll cry if you hate us. But I might do a happy dance if you love us. And the second thing is, I have this thing called the Financial Freedom Project. And part of it is what we've been talking about for the last 20, 25 minutes or so. And here's what the Freedom Project does for you. First, you find out where you are on the road to becoming financially free from your business. And this is a really big deal. Most business owners think they're doing way better than they really are, and you need to have some reality set in. The second piece is if we find out, and often we do find out, that you are short on the way to financial independence, we are going to get you a strategy that you can use in your business that will provide enough excess cash that will allow you to fund what you need to get to financial independence. Now, you have to have a conversation with me before I accept you in the program, because that's a guarantee. If I can't come up with the strategy, I give you your money back. And it's really simple. I used to charge $5,000 for this. Now I'm charging $997 for it. I found some software where it took 80% of my time out of it. So I'm giving you all that back as a discount. To find out more about the Financial Freedom Project is really easy. You go to www.sustainablebusiness.co/financial freedom. That's www.sustainablebusiness.co/financial freedom. You can sign up for the program there, or you can sign up to have a call with me to learn more about the program. So this is Josh Patrick. We're with Eric Hoelter. You're at Cracking the Cash Flow Code. Thanks a lot for stopping by. I hope to see you back here really soon.